The world is facing a global pandemic. Nations are struggling to contain it and economies are trying to outlive it. All around the world, the economies have begun to fall. IMF predicts the world economy to shrink by 3% and India's economy is expected to grow by just 1.9%. This would cause about 195 million job losses around the world, and the current situation could effectively become an economic time bomb. But let me tell you the story of the financial crisis of 2008, and that story has its roots as far as 1944. World is at war. In 1944, the US government introduced a bill called as the GI Bill for assisting the returning military veterans of the war. US government began to back World War II veterans with cheap home loans through GI Bill. Banks were flooded with house loan applicants and the bill helped them to acquire loans easily. The idea behind this bill was to help US citizens to build back their lives slowly after the fallout of the war. Every home built on a barren land stood as a symbol of resilience of the US citizens and their willpower to rise like a phoenix bird after a devastating war which had weakened the US economy. Owning a house therefore became a matter of prestige and value in the American society, and that fueled the high demand for homes in the US. Credit is an important aspect of an economy. Lender agrees to pay a certain amount as loan to a borrower, and the borrower agrees to pay it back within a mutually agreed period. In most cases, the borrower guarantees the repayment to the lender by providing him a real estate land or property as a collateral, which means in case a borrower fails to repay the loans, the lender can confiscate the borrower's property. Such an agreement is called mortgages. Interest rates on loans keep the borrowing cheaper or expensive. If the interest rates on loans are low, borrowings become cheap and more people take up loans. Transaction keeps an economy alive. Someone earns when somebody spends. With the loans they take, people build new home, they buy new appliances, they get a new car and so on. With money in hand, businesses prosper and this leads to new jobs. When people engage in jobs, they get a regular income in hand. Then they spend this to buy goods, for healthcare and so on. Spending is what drives the economy. Whether you spend it, the government spend it, it's all transactions. Money flows in and out of the market, raising income and increasing productivity, which in turn prospers growth. Thus, a cycle of income generation, spending, and economic activities is created. But have you ever wondered what happens to the money we deposit in the bank? Let me give you an example. Your friend is going out of the country and he decides to leave his car with you. So you think, why just keep the car idle? You decide to give it to a rent-a-car firm and they pay you for the car. You are now earning income for an asset which is not actually yours. This is generally how the banking industry works. The money we deposit are not lying idle, but they are diverted to other investments and various transaction instruments like bonds, mutual funds, or even they lend as loans. To put it simply, they make profit out of what we deposit with them. By early 2004, due to the growing demand of houses, the house price began to skyrocket. Banks were providing house loans at very low interest rates and people took loans at large scale. Loans were made available for everyone, irrespective of their creditworthiness. Creditworthiness of a borrower is determined by his or her ability to repay the loan back to the lender. A high credit score indicates the borrower's ability to return back the money he borrowed on time. Another way credit or money flows is through investors who search for opportunities to invest their money and reap profit out of it. Money they invest is a spending, and as said earlier, spending is what drives the economy. The US investors were looking for an alternative investment plan apart from the usual investment platforms like bonds, shares, etc. Why? To make more money. Investment bankers like Lehman, Freddie Mac, along with greedy banks, bundled up the mortgages of the borrowers in the banks and thus provided an unique investment platform for people to invest called CDO or collateral debt obligation, an investment opportunity backed by the properties of the borrowers who took loans from the banks. These securities were called mortgage-backed securities, since when someone invests money in these CDOs, they get these mortgages as a guarantee for their money invested. In midst of all this, insurance companies like AIG put fuel to the fire when they started insuring the CDOs, which potentially reduced the risk factor in minds of investors. This gave investors more confidence to invest in this instrument, and hence the demand for MBS increased. In order to meet those growing demands of the investors, the banks kept on lending easy loans to common people and kept their houses as collateral. Their thirst for money blindfolded the reality and hoped that this bubble would never burst. Easy lending by banks led to disproportionate amount of people borrowing money and increasing their spending, particularly on houses. This increase in demand for houses increased the price of houses, so people took out larger loans to buy new house. A vicious cycle began to form. The Federal Reserve, US equivalent of Reserve Bank of India, raised the interest rate over a dozen times in an attempt to slow this down. As interest rates are increased, people could no longer take loans. Thus, the Central Bank of US put a stop to this uncontrolled run of loans by increasing the interest rate and kept people away from taking loans. But increase in interest rate have got another side. This increased interest rates, however, made it difficult for millions of Americans who have already availed the loans to pay their monthly installments, and they soon started skipping their EMI payments as they didn't have enough money in hand to pay the EMI. This forced banks to confiscate the property and foreclose the loan. Do you remember? The properties for which they were paying the EMI were given as security to investors in CDO scheme. And now, as banks started confiscating the properties and started closing the loans, these mortgages simply lost its underlying value. In basic economic perspective, when the demand for a commodity increases, its price too rises. At the same time, when demand among people falls, the price falls as well. Thus, the demand for CDUs decreased, and in 2007, the real estate bubble just burst. Investors began to lose confidence in the CDU. People began to panic. They ran into banks to withdraw their deposits. Money flushed out of the banks. As people took out money from their banks, it eventually reduced the money available in the market, which in turn reduced spending. As people started to default on their payments, banks started to foreclose their loans. Many lost their homes, and some were even pushed to bankruptcy. Banks lost confidence among the borrowers and thus stopped lending loans even to genuine borrowers, creating a credit crunch which affected almost all industries and their income. Just like friends lend money to each other when in need, banks also lend each other money for working capital requirements. The lack of confidence among lenders and borrowers even affected lending of such short-term loans between banks. Interbank loans were extremely hard to place. As the short-term money market began to break down, the economy went into severe collapse because even profitable businesses were unable to attract working capital to run business. As businesses ran out of money, they started to close down, leaving many people unemployed. Unemployment in the US soared from 6% to more than 10%. All this created enormous social hardship for the public. Large banks and companies across the US closed down. Among them, the investment bank Lehman's collapse was a groundbreaking event that greatly intensified the crisis and contributed to the erosion of close to $10 trillion in the market capitalization. Around 20 million people lost their jobs. Shares across the global market plunged. Inflation shook markets. Banks went out of cash and trades dropped to near zero. A healthy economy would have lots of money flowing through it. There are many factors which can block this money flow. High interest rates. If the interest rates for loans are high, borrowings become expensive and people take less loans. And if the interest rates on bank deposits are high, depositors get more money from their savings in their bank accounts. This encourages people and companies to save more and borrow less. When we save money, it means we have stopped spending, which will block the money flow into the market. In 2008, when US government raised interest rates on loans, it raised interest rates on deposits too. Thus, people took less loans and instead deposited their savings in their bank accounts, since a higher interest rate increased their savings. Consumer confidence. Consumer confidence means the belief of the consumer on the stability of the market. When a consumer loses his confidence in the market, this would pressure them to hold on to their money rather than spending or investing it. Crash in the US stock market in 2008 is a perfect example to explain this psychological dilemma. Stock market crash would lead to loss of confidence among the consumers. Inflation is another important factor. Inflation causes the prices of the goods and services to increase. When price of a commodity increase, people prefer not to buy that product unless it is an essential commodity. Inflation is further classified into three. Cost push inflation. As the name indicates, it occurs as a result of an increase in the cost of production. That is, when the prices of inputs like raw materials, labor increases, the production of the goods or services become more expensive. Demand pull inflation. Demand pull inflation occurs when the overall demand for goods or services increases faster than the production capacity of the economy. This type of inflation leads to a demand supply gap, which results in an increase in prices as more people run behind a limited supply. Built-in inflation. Expectations of future inflation can cause built-in inflation. That means when prices rise, workers expect and demand higher wages to maintain their cost of living. However, higher wages result in higher cost of production, which leads to higher prices, and thus a cycle begins. This higher cost of products and less availability of money in hand would lead to less demand, which causes less production, and as a result, the growth of economy decreases. There is another angle to this. Inflation leads to increase in price of the product, while deflation is the opposite. We have already said that one person's spending is another person's income. As spending decreases, income to somebody else decreases too. There is also a chance that when people spend less means the demand is less, thus price of the product goes down, and this is called deflation. Thus economic activity decreases and we will have recession. This is what happened in the US in 2008. As dollar lost its confidence among the investors, it eventually weakened the position of the dollar in the market and added recession to the already bedridden US economy. US economy till 2008 was always considered safe and robust. US dollar was pegged as one of the strongest currencies in the world, as majority of the transactions and trades in the world was and is conducted through dollars. Larger banks in Europe invested their excess cash in US markets. Not just banks, even governments and larger corporations across Europe and Asia did the same. When the US market collapsed during 2008 financial crisis and larger US companies began to close down, it caused a tremor even in the European market, as they had heavily invested in American debts. Due to this panic, European governments started whittling its vast foreign reserve from the US to finance aid programs for its own banks in case of an anticipated collapse. Eventually, this crisis and its ripple effect reached the Asian market. Asian continent is rich with fast-growing economies like Hong Kong, Malaysia, Singapore, etc., aptly named as the tiger economies. But these countries depended heavily on the export market. As the recession of 2008 carved the pockets of the US Fed Reserve empty, the export market in Asia began to feel the heat, since there were no buyers for their export. This caused a sharp decline in their net export value, which took a toll on these tiger economies. The world began to feel the burn of the fire kindled by US banking sector. But as the financial crisis of 2008 wreaked havoc in the US market, and while the European governments were struggling to keep their markets calm to avoid a potential crash, and as the tiger economies prepped themselves for an economic crisis as their exports began to dwindle, an unsuspected sleeping giant, tagged as the elephant economy, withstood the crisis on its own: India.